It's called a cramdown. Joining us to talk about its impact in the banking and mortgage industry, Robert Satnick, who is president of the California Mortgage Bankers Association and president and CEO of Prime Financial Services in Van Nuys. Thanks for coming back.
Good morning. It's a pleasure to be back with you, Pat.
Well, so tell me, Mr. Satnick, we got a bit of an understanding from Congressman Miller as to how your part of the financial world is reacting to this measure. Can you elaborate?
Well, as you know from the last time we spoke, that this is something that most of us in the banking and mortgage lending industry are fairly opposed to, and the primary reason is basically one simply of liquidity, which we've already experienced a tremendous lack of liquidity in the mortgage market. I mean, we're hearing every day reports about people finding it difficulty to obtain financing. I fear that the long-term outcome of some sort of forced cram-down process here is going to be that investors, as they do return into buying our securities and buying the investments in these mortgage loans, and banks themselves who are lending their own money, there are still a number of very strong, solid portfolio lenders. They're going to look at this situation and say, you know what, it's too dangerous, it's too risky. I don't know that I want to participate in this, and we're going to see further drawing up of capital and making it even more difficult for homeowners to find financing or refinance capital when they need to.
In the meantime, one of the changes that was made to the bill was to make homeowners show that they had worked with the bank had given them some kind of reasonable deal to rework the loan before deciding to go to bankruptcy court to get some kind of cram down. Is that something that you think is going to go a long way toward resolving this problem?
Well, I think it certainly does help, and I'm glad to see that reached, but at the same time, I would have liked to have seen, before we have to take such a drastic measure in terms of looking at this cram-down legislation, just today the Obama administration released their whole new proposal and the plan for all the loan modifications. Let's give that a chance to work. Let's see how lenders implement that, and before we take another threatening, possibly devastating act. The other comment that the congressman had made was about that this is nothing new. These contracts, a mortgage is the only contract that can't be modified by the court. But the one thing that I jumped out at me in all that is most other contracts don't have any other way to exit those contracts except through bankruptcy or to modify them. Mortgages, the trust deed does provide for a number of possible solutions. Homeowners do have a number of solutions available. Some of them are as drastic as selling the property or foreclosures. Now we're seeing lots of loan modifications as a way of doing it. And, if they can work this out before they even get into financial trouble, there is always the possibility of refinance. The fear that I have is that consumers might take this as a way to saying, I need to go into bankruptcy so that I can force this change, and not pursue any of these other changes or decline other changes, modifications that are given to them. Just as a way of getting back at the banks or to try and negotiate a better deal for them. That
might be what some consumers would choose to do, but from the point of view of bankers, of mortgage bankers and lenders, could this measure be a kind of sword of Damocles that really nudges them to working out deals more assiduously and more intensively with homeowners, rather than just saying, "Look, we're willing to let you lose this house and walk away from it"?
It's hard to say on that one. Certainly, all those types of risk factors are something that would be taken into consideration as to what other outcomes and possibilities would evolve. But at the end of the day, the lenders are going to, and I believe they already do this in many cases, and there's always going to be an exception. They already are negotiating, putting the best deals forward that they think they can, and in terms of looking at what kind of a payment that the borrower can afford and trying to keep them in their homes. And I've said this before, banks don't want to take back property. They own enough property. They want to keep borrowers in their homes, and they understand that there is a vast number of factors that are causing, whole economic issues that are causing people to find it difficult to make those mortgage payments. And in many of these cases, one of the comments that was made is about, payments have gone up in some cases. Well, in some of these cases where modifications have been done and payments have gone up, what's being missed is we're also taking them out of an interest-only loan or an adjustable rate mortgage and putting them into some sort of a fixed rate mortgage with principal and interest payments at a payment level that they can still afford based on 33-38% ratios. So just to say that someone's payment is going up doesn't mean that it was a bad solution for them. It may actually put them into a better long-term position with that transaction.
The congressman was casting this in some ways as kind of a win-win, that the bank doesn't end up getting a house returned to it, getting the keys back in the mail when it would rather keep somebody in the house and keep payments coming. And the homeowners would get to stay in the house with a different payment schedule. And really it's sort of like a divorcing couple, forcing them in to sit down and mediate with each other.
And I think that is the whole purpose of going through the modification process initially. And again, back to the fact that the borrower does have a number of other options before having to resort to something through foreclosure or through the bankruptcy court as a way to negotiate out of a mortgage payment. There are a number of other solutions available to them, and that is what the bankers would prefer to see, is that we look at all these other solutions, because it does all come back down to, at the end of the day, we want to make sure that as the economy does get growing again, as people start finding jobs again, that we can continue to seek the investment capital both domestically and internationally to make sure that we continue to have a thriving capital market, secondary market, and real estate market. And if investors are going to find that they're not going to be able to get their capital back, they're not going to want to lend it to us for the purpose of making new homes.
As far as getting capital back, though, once the market does improve and people don't have so much trouble paying off their mortgages and staying in their houses, is that not going to make housing an attractive investment all over again and make this law, in a way, moot?
Well, but unfortunately, though, once laws are on the books, sometimes they're very hard to get off the books.
Mm-hmm. Yes, I think we've seen that in the past. Yes. So, and so once this kicks in, the practical effect for mortgage bankers is you're going to be spending more time in bankruptcy court. You're going to be spending more time mediating with homeowners.
Presumably that might very well be the case. Yes.
Robert Satnick is president of the California Mortgage Bankers Association. He's also president and CEO of Prime Financial Services in Van Nuys. Thanks as always for being here.
My pleasure. Thank you again.